Hi everyone, welcome back to the Option Guide. Today we are walking through a dummy trade example on Apple. The stock is currently trading at 254.63 cents. We will be setting up a covered call trade that expires on October 3rd of 2025. Remember, this is for educational purposes only, not a financial advice. Let's dive in. Here you can see the Apple options chain. I'm focusing on the October 3rd, 2025 expiry and specifically the $265 strike price option. The last traded price here is around 19 cents per share, or about $19 per contract. Notice how I have highlighted this row. This is the option we will be selling in our covered call setup. So here's the actual structure of the trade. We are buying 100 shares of Apple at $254.63 each, and at the same time we are selling one call option at $265 strike price, which will collect us a premium of $19.10 for the whole contract. That premium comes into our account upfront the moment we sell the option. Now let's break it down. We collected 19 cents per share in premium. So our break-even point on this trade actually drops slightly to $254.44 instead of $254.60. That means Apple could fall a little and we would still be covered by the option income. This is one of the main benefit of covered calls. You will bringing in a cash flow and lowering your break-even. Here's the payoff diagram for this trade. You can see that our upside is capped at a strike price of $265. Below the current price, we lose money just like a stockholder would. But above $265, our profit flattens out because the shares would be capped away. We have marked the entry price and the strike price so you can clearly see where the profit and risk lies. On this version of the chart, I've added annotations. The green shaded area here shows the income we earn from selling the call. That's the premium. The flat part above the strike shows where our gains are capped. And on the left side, you can see the downside risk, which is simply the stock falling lower. Remember, the premium helps, but it does not protect you fully from a stock decline. Here's a clear breakdown of how the numbers work out. In the first column, you see the profit or loss from simply holding the shares. In the second column, you see the options income or loss. At the last column, adds them together to give up the total outcome. For example, if Apple crosses at $260, our share makes about $537 plus we still keep the $19 option premium, bringing the total to around $556. On the other hand, if the Apple falls to $240, we would be down over $104,400 on the shares with only 19 from the options to offset. Now, how do we manage this trade? We really have four choices. First, we can let the option expire worthless if Apple stays below $265 and we just pocket the premium. Second, we can buy back the call option if we want to early exit. Third, we can roll forward, close this position and sell another call at a later expiry. And fourth, we can hedge downside risk by buying a put option. Each of these strategies has pros and cons, and the choice depends on our view of the stock and the risk appetite. Finally, here's a quick look at how strike and expiry selection impacts the trade. Notice that options closer to the stock price have higher premium, but they also carry high assignment risk. Longer expiries bring in more premium, but they tie up your capital for longer. That's why strike and expiry selection is so important. And here's the exciting part. On October 3rd, the day this option expires, I'll make a new video showing you exactly how much profit or loss this dummy covered call actually made. So make sure to subscribe and stay tuned for the update.